Hi, everyone, and welcome to Behind the Numbers. This is the show where we go beyond the data to explore the people, the stories, the insights that really drive business success. I'm Dave Bookbinder. I'm known as a business valuation expert and best-selling author, and I appreciate you for joining me today. Gang, on this program, we've talked a lot about how business owners could exit their businesses. We've talked about the strategic sale. We've talked about financial buyers. But we haven't really given a lot of attention to one other option, which is the sale to employees through a vehicle called an employee stock ownership plan. And today I have one of the nation's leading experts on ESOPs. His name is Kelly Finnell. He's president of Executive Financial Services, and he's also author of the ESOP Coach. Kelly, welcome to Behind the Numbers.
Thank you very much, Dave. It's great to be with you.
Besides the little blurb that I just shared with the audience, tell the listeners a little bit more about you.
Well, I have been in the ESOP business for over 44 years now, which is exciting on one hand, but a little depressing on the other, to think that I've graduated from law school in 1981 and have hit the ripe old age of 70 this past summer. ESOPs have been the focus, or one of the focuses of our business for the first 25 years I was in business, and have been our exclusive focus for more than 15 years since. So we do ESOPs all over the country. We do large and small ESOPs. We've got a boutique firm focused exclusively on this specialty, and we do about 10 transactions a year. So we've done over 200 transactions during the history of our firm.
That's awesome. My recommendation is just tell people like I do. I've been doing this way longer than I care to admit, and keep some mystery about it. We're going to unpack all the myths, dispel some of those, and the benefits of ESOPs. But let me start off by asking you this: you're known as the ESOP coach. So, and you mentioned that you focus exclusively on ESOPs. What led you to focus the practice on ESOPs as a succession and liquidity strategy?
Well, there were many things, but like many entrepreneurs, my story involved a little bit of just good luck. After my first year of law school in 1979, ERISA, the law that codified ESOPs, was only 5 years old, and I was working for a firm in Massachusetts that summer that was a group of pension lawyers. And they got a letter, this is before email in 1979, they got a letter delivered by the U.S. Postal Service asking for a white paper on ESOPs. And all of these experienced ERISA lawyers looked around at each other and said, we don't know anything about ESOPs. We're going to give this project to the kid. And in 1979, I was the kid. And so I started researching and writing about ESOPs that year, and just loved the concept of being able to offer a business owner an alternative to the traditional exit strategies that you mentioned before, an alternative that would allow them to sell to their employees using a tax-advantaged vehicle created by Congress through ERISA in 1974.
That's amazing. Give the task to the kid. Well,
Yep.
well done, kid. You've come a long way, baby, since then.
Thank you.
Kelly, when you talk to business owners for the first time, what are some of the misconceptions or myths about ESOPs that you most often hear?
Well, the number one myth is that if I sell to an ESOP, I'm not going to receive as much in the purchase price as I would if I sold to private equity. We, over the years, have had about 25 to 30% of our clients each year, before they came to us, go through a process where they hired an investment banker, and that investment banker shopped the company. And in that process of shopping the company, found a couple of potential buyers. The business owner met with those potential buyers and decided for whatever reason that just didn't feel right. And so they come to us with a price that they have in mind from one of those traditional kinds of buyers. And the first thing they say is, I'm sure that if I sell to an ESOP, I'm going to be sacrificing value. And that has never been the case, not one time in all of these years of experience. And I know that's very counterintuitive. Um, Almost every business owner we talk to assumes that private equity is going to pay more, but in our experience, they don't. And the reason for that is that private equity serves two masters. Their primary obligation is to those people who have invested in the private equity fund. A private equity fund is an alternative investment strategy for high net worth investors. And so they want a return in excess of 15% on the money that they invest. So if you're serving two masters and one of those masters needs a 15% plus rate of return, the other people that you're serving, the company's employees and the business owner who's selling, they're not going to be able to get as much value as they would if they sold directly to the employees without having to produce that 15% plus rate of return that goes to the investors.
Yeah, exactly. Those hurdle rates can certainly be challenging, not to mention the reporting requirements that come along with the sale to PE and other aspects, but we won't get into those right here and right now because we're going to focus on ESOPs. And in your experience, what's motivating owners to choose an ESOP beyond taxes, beyond valuation? Like where does culture, legacy, and just keeping it, quote, in the family come into play, if at all?
Yeah, those are primary drivers for all of our clients. Our clients appreciate the tax benefits that an ESOP offers, but their primary motivation is to take care of their employees. So I refer to these people as conscious capitalists, people who want to do well for themselves and their families while doing well for others. And that includes their employees and oftentimes their communities. And so we see in many of our transactions the owner making charitable contributions from the proceeds that they receive from the ESOP. And so those are the types of folks that are attracted to ESOPs, people that want to recognize and value the fact that they didn't build this company by themselves. There were employees over the years, over the decades, that helped them do this, and they don't want to sell out to a third party and have that third party not treat their employees the way that they've been treated. And so when we talk to a business owner during a first meeting and I ask them what's the key to their company's success and they say culture, then I know that they're a good candidate for an ESOP because you know that a private equity buyer is going to tell you after the sales nothing's going to change, but the reality is that everything changes and the culture of the acquired company becomes the culture of the acquiring company. And there are just many business owners who don't want that to happen. They don't realize that they have an alternative where they can recognize full value and still take care of their people. But that's what an ESOP provides.
Yeah, and folks out there who listen to this program regularly know that I write about and speak about the impact that culture has on enterprise value. So, exclamation mark on what you just said. Um, when you're thinking about, we'll call it a right fit candidate for an ESOP, Kelly, what are some of the red flags that you see besides the cultural aspect? What tells you it's maybe not the right structure for a candidate?
Well, there are certain financial metrics. A company needs to have at least $2 million of adjusted EBITDA in order to be a good candidate for an ESOP. So I often tell people that ESOPs are appropriate for mid-size and larger companies. They're not appropriate for micro-size companies. And so as a rule of thumb, and of course there are exceptions to every rule, but as a rule of thumb, you need to have at least $2 million of adjusted EBITDA and at least 35 employees. And very importantly, you need to have a strong successor management team. So I often tell business owners that the best candidate for an ESOP is a place where the boss comes in late, takes a long lunch, and leaves early. because he's already got in place that successor management team. And ESOP is a type of internal transition. And in order for any internal transition to work, you have to have a successor management team that's going to run the company after the owner leaves. And almost all of our ESOP transactions involve the owner creating a runway or a path to an exit, as opposed to being an immediate exit. So you need to have that team in place. The owner often continues, he transitions to the role of chairman of the board and provides strategic advice, continues to maintain relationships with a few key clients, and then exits gradually.
Yeah, it's funny. You talked about having a team in place. I was on a panel not too long ago speaking to a bunch of business owners, and I asked the audience to raise their hand if their business would disappear if they got hit by the proverbial bus tomorrow. And a lot of hands went up in that audience, and I explained to them about key person risk and why your business is more valuable, to your point, if you're not the only person running the show.
Yes.
So appreciate you sharing that. It's a keen insight that many business owners may be overlooking. One of the structural aspects of ESOPs is the introduction of a trustee that represents the employees. Talk about that aspect of it, and how does that change negotiations?
So the business owner is selling the company to its employees through this conduit of the ESOP. And an ESOP is a form of a retirement plan, like a 401k plan. And every retirement plan is required to have a trustee. The job of the trustee in an ESOP transaction is two key points. First, to ensure that the employees don't overpay when purchasing the business from the owner. And so that is a valuation issue. And so the trustee hires a valuation advisor. That advisor gives the trustee a range of value, and with that knowledge, the trustee negotiates purchase price with the business owner. And at the end of the process, the financial advisor, the valuation firm, issues a fairness opinion in which it certifies that the trustee did not pay more than fair market value, so the employee's interests were protected there. The second key job or responsibility of the trustee is to ensure that all of the terms of the transaction, the non-price terms, that all of those other terms are commercially reasonable. And so those are the two key responsibilities of the trustee. It provides a very elegant, logical way for employees to purchase a company. If you tried to create a committee of employees to purchase and to negotiate, it would be a disaster. The employees don't have the knowledge and the experience in order to be able to do this. And these ESOP trustees, that's all they do. Many of them are CPAs and MBAs. Many of them have been CFOs of companies, some of them CFOs of ESOP companies. And so they are professional and experienced in discharging their duty as the trustee, and they have assistance from experienced independent valuation advisors, and they hire their own legal counsel.
Yeah, so they're looking out for the employee's best interest, and they're also assuming risk associated with the transaction, right?
That's right. As fiduciaries, they are responsible to the Department of Labor. So ERISA, the law that governs ESOPs, is enforced by the IRS and the Department of Labor. I say that in ESOP enforcement world, the IRS is a lapdog, but the DOL is a bite dog. And so they are monitoring these transactions to make sure that the trustee is fulfilling its fiduciary obligation. So there are several layers of protection for the employees.
Yeah, and in getting the deal done with the employees don't necessarily have deep pockets, so the transaction structure frequently, if not always, includes some form of debt. What should business owners understand about deal structure as they're entering that process?
Yeah, you're exactly right. Most ESOPs are financed with a combination of three sources of capital. And so the first source would be a bank loan. And so that involves the company going to a bank, and the company is the borrower. And then the company relends that money to the ESOP. One of the key differences between an ESOP loan and most of the loans that a business owner has secured for the company over their life is that we almost never, I can take that back, not almost, we never see a personal guarantee in an ESOP loan. And so that is something that business owners are thrilled to hear about and surprised that their company can borrow money without them having to provide a personal guarantee. And so that's the first source of capital, a bank loan. And typically, a company with less than $10 million of adjusted EBITDA can borrow approximately 2 times its adjusted EBITDA. And so let's assume that we have a company that has 2 million of adjusted EBITDA. Let's assume that the valuation was $10 million. And so that company is going to get $4 million of bank debt, or 40% of the purchase price. Let's assume that this company also has excess corporate cash not needed for operations, and the company loans $1 million of excess cash to the ESOP. Now we've got half of the purchase price in cash to the owner at close, and the rest comes in the form of a subordinated seller debt. And so that seller debt has the company paying interest only until the bank loan is paid off. Then, two options. The company can pay off the seller debt on the schedule that was agreed to on the front end, or more likely, the company is going to go back to the bank and say, look, that worked so well, let's do it again. And so let's assume that the company's grown. It's gone from $2 million of adjusted EBITDA to $2.5 million. You can borrow it 2 times. That's $5 million. And that gives you all of the money that you need to buy out or prepay the seller note. And so our seller can be completely paid off in 3.5 to 5 years.
Gotcha. Thank you. Um, we talked a little bit about culture, and that's one of the compelling arguments for ESOP is maintaining or shifting the culture. What have you seen with regard to any changes in employee mindset, productivity, engagement once people become owners of their business?
Yeah, there are academic studies. One of the favorite subjects of dissertations for people that are getting a PhD in management is to study ESOP versus non-ESOP companies. And if you Google it, you'll see a lot of studies that come out of Rutgers University on this subject. And so there is solid empirical data that supports the fact that ESOP companies are more productive before they set up the ESOP. They're more productive after as a result of that employee ownership. They're more productive than similar competitive companies that don't have an ESOP. And the companies have lower turnover than companies that don't have ESOPs. So it's not just intuitive that employees would be more tied to their business and more motivated since they're now owners. There's lots of empirical evidence that that intuition is reality.
For sure. I mean, if you're an owner of the business, you're going to behave differently than somebody who doesn't care, right?
Right. It's like
And
between owning a home and renting an apartment. You take much better care of the home that you own than the apartment that you're just renting.
yeah, and you're invested in success literally and figuratively because as the company does better, you're going to do better with your ownership interests. So,
Yes.
with that sort of as the backdrop, how should leaders communicate ESOPs to their people so that they understand what it really means to them, both in terms of financial aspects, but also in terms of their accountability and that ownership mentality that we just talked about?
Yeah. Communication is key to the success of an ESOP company. I tell business owners, look, you've spent a lot of money to set up this ESOP. And if you want to maximize the value of that investment, then your employees need to understand what the ESOP is, how it works, and how it benefits them in order for this thing to have been a wise investment on your part. So employee communication, as you're suggesting, is key. This week, I was in Atlanta, met with two of our clients there, did the initial employee rollout meeting for one of them. Their plan has just become effective. And so at the beginning of that meeting, the business owner explained the history of the company, the alternatives that he considered, sale to private equity, sale to a competitor, sale to an ESOP, and told them why he selected the ESOP so that he could protect and reward them. And then I got into some of the detail of what an ESOP is and how it works, and spent a lot of time answering their questions. The next day, I went to one of our clients that has had their ESOP for a year. And I spent time with them, reminding them of what they had learned the first year. And in that second meeting, after they've had the plan for a year, they have a lot more questions. And so we spent a lot of time answering questions. And at the end of that meeting, we handed out their first annual statement, which is what really causes the ESOP to come to life for the employees. So communication is critical. So many of our clients post banners or posters around the building talking about the fact that they are an employee-owned company. They often put that message on their equipment and their trucks. They put it on their letterhead. It's spread out everywhere so that it's always in front of the employees and, importantly, in front of their customers. Because
bingo. I was just going to mention that too, because what you're talking about here and placing that everywhere, yes, it's part of communication, but what I'm really picking up on that whole thing is pride. And so that's key. And customers, I think, get it when you talk about the intuitive data. They know that an engaged workforce is going to serve them better.
Exactly right. And it can give businesses a competitive advantage. When you go in to pitch a new customer and you explain to that potential customer that your employees are going to take better care of them because they actually own the business and their future financial security is dependent upon them taking better care of you, then that gives you a competitive advantage.
That is pretty compelling stuff. One of the other advantages that we've talked about a little bit was the tax aspect. And let's get into that just a little bit, because ESOPs are often described as the most tax advantaged liquidity event. So what are some of the key tax benefits that owners need to know about?
There are two key tax benefits. The first is a tax benefit potentially for an owner that sells to an ESOP. Section 1042 of the code was added to the Internal Revenue Code in 1984, so 10 years after ERISA. And it says that if an owner sells C Corporation stock to an ESOP, with lots of other requirements around that, and takes the proceeds from that sale and invest it in like-kind properties, so this is a like-kind exchange provision, that the seller is not going to be taxed on the gain from the sale to the ESOP because he had the stock of this closely held company. The requirement is that that be reinvested in like-kind property, which would be a stock or bond of a U.S. domestic operating company. And so as long as you do that, there's no tax on that sale. And so that can be very attractive for business owners. But the big tax break is for companies. If you have a 100% ESOP owned company, that company is going to operate on a tax-free basis. And that sounds way too good to be true. And the vast majority of business owners I talk to don't realize that's a possibility, that their company can operate like a church or a synagogue, no tax on its income. So that was added to the code in the late 90s. And so this is not a loophole. This is not something that the IRS is going to figure out one day that's available. This is something that has been in the code for over 2 decades, and that many companies, many high-profile companies, are taking advantage of. So Publix Supermarket is the largest ESOP-owned company in the country with over 300,000 employees and beneficiaries of their ESOP. And they compete incredibly well with Kroger because their employees are invested in the success of the company and because Publix doesn't pay tax. So just an enormous financial benefit. It results in the company being able to pay back the debt much faster than it would if it had to send a big portion of its profits to Uncle Sam.
Yeah, and I'm imagining a lot of people leaning over, turning up the volume knobs on the radios as you're telling them that they don't have to pay taxes, because I know that resonates with so many business owners. Tax often wags the dog inappropriately at times, but it's a keen issue for them. And it's interesting in the accounting space with private equity infiltrating a lot of accounting firms and making investments in them. There was one large accounting firm, BDO, I think it was, that instituted an ESOP as an alternative strategy.
Yes, it just happened within the last year and a half. And I think that it is kind of the ultimate refutation of one of the ESOP myths that I've heard for decades. There were people out there, investment bankers and private equity people, who would say that an ESOP, that's just for tiny companies where the owner is financially unsophisticated. Sophisticated, smart people are selling to private equity. Well, you've got one of the largest accounting, tax advisory, and consulting firms in the country that did an ESOP. And so I think that totally refutes the argument that they're not for financially sophisticated companies when you have one of the most financially sophisticated firms in the country doing an ESOP.
Yeah, especially when you look at the landscape where PE is infiltrating pretty much everybody else. So,
Yep.
for sure. We're getting down to the end of the line here, and this has been an amazing conversation. But before we do wrap, I want you to share with the audience, what should business owners really understand about ESOPs that they usually don't? Maybe something we haven't touched on here, or if there's something that you want to reemphasize that we've already gone over.
I think that there is an alternative to selling to private equity, selling to a strategic buyer, or dying with your boots on. And an ESOP is not the right solution for every situation, but it's something that is dramatically unconsidered and that business owners would do well to just educate themselves a little bit about ESOPs. Listen to podcasts, read articles, read my book, the ESOP Coach, and become educated about other options. Talk to friends that have done ESOPs. I mean, I think 30 years ago, if I asked a business owner if they knew anybody in their industry that had done an ESOP, many of them would say no. Today, most of them would say yes. So talk to those people. Talk to ESOP professional advisors. Become educated, and then weigh all of your options. And if an ESOP seems to be the right option, hire an advisor to help you through the process.
Yep. And you just created some great content that's going to be out there for the world to listen to help these business owners learn more about ESOPs. Before we go, Kelly, tell the world a little bit about your book, where the audience can find it, what they'll learn from it, and how folks can connect with you if they want to learn more about how to work with you.
Yeah, back in 2008, the Great Recession started, and there weren't many people doing ESOPs during 2008 and 2009. I don't deal very well with boredom, and so I needed a project, and my project was to write a book on ESOPs. And I didn't want to write just another book like the other ones that were out there. And so there were many books out there written for attorneys and CPAs and investment bankers that explained all of the technical aspects of ESOPs. My book is written for business owners, and it's the only book out there that explains ESOPs in business owner language. And so the first few chapters are discussions with lots of illustrations, and there are 5 or 6 chapters that are case studies. And I think that's one of the ways business owners learn best. Find a case study that is similar to your company, read about what that business owner did, and then decide if it might be something worth exploring. So the name of the book again is The ESOP Coach, and it's available on Amazon.
And where can people find you, how they can connect with you?
Yeah, our website is www.execfin.com. So we've got lots of educational information there. My email address is kfin, K-F-I-N, at execfin, EXECFIN.com. So feel free to reach out. Either me or one of my partners will reply.
That is awesome. Thank you so much for sharing this great insight with us today, Kelly.
Thanks, Dave. Great to be with you.
It's been a pleasure. And thank you out there for listening and supporting Behind the Numbers with Dave Bookbinder. I truly appreciate your support. If you learned something today, please feel free to give us a thumbs up, leave a review on Apple or Spotify. That really does make a difference. And if you know a business owner that would benefit from this conversation, definitely share it with them. I know they'd appreciate it as well. Until next time, I am Dave Bookbinder, reminding you that the numbers tell the story, but the people bring it to life. Take care, everybody.